Thank you. It's good to see all of you here this morning. Today we're going to take a little bit of time to talk about the changes in benefits for clergy. At annual conference, we focused on the changes in the billing process to the local church. Today we want to talk about the changes to you as clergy members of our annual conference. We're going to start off with showing a video. Bob was unable to be here this morning. A video from Bob Long, who serves also on the General Board of Pension and Health Benefits. Then Stephen is going to share some changes on the pastor's compensation form. There are changes because of the change in benefits. Your compensation forms are going to change for this year. And then we're going to have opportunities after each one of those segments to ask some questions. We're also going to share with you about an important mailing that just went out of our office yesterday to every single church and pastor, chair of SPRs. This is critically important that you hear that the documents that you've got to send to your church employees is mandatory by the federal government and must be sent to every employee, which means you as an employee of your local church are to get those before October 1st. And Stephen's written a very thorough letter and examples of that communication that every single church is required to do. I want you also to know that you'll be receiving very shortly communication from the General Board of Pension and Health Benefits concerning the changes effective January 1st, 2014 to your pension plan. Understand that every conference is a little bit different on the benefits that they choose, and we're trying to work very closely with the General Board to make sure that the mailing they send you reflects what we are doing here in the Oklahoma Conference. No guarantees on that one, though. Remember, I said this back before annual conference, you're going to see more changes each year for the next several years that we're going to be facing concerning benefits for clergy and lay people. Changes are going to be in effect because of changes in our national benefit environment, changes we see in our denomination, and changes we see in the very demographics of our annual conference. I cannot stress the importance enough of keeping track of the changes you hear for the next couple of years. Please appreciate that every year for the next several years, I can guarantee you there will be some changes to the benefits of clergy in our annual conference. So please pay attention to what we're doing. With that said, let's sit back, relax, and enjoy a video from Bob.
Good afternoon. I'm sorry I don't get to be with you this afternoon. I made a commitment to be out of town on this date over a year ago, and I really couldn't change it. But I really did want the opportunity to talk to you about our pension program, and I was so very grateful that Brian asked me to do this and to kind of bring you up to date on the changes that have taken place. Back around annual conference, we cut a video to explain how the benefits of the pension program and health care were going to affect local churches. Today, I really want to talk to you about how it's going to affect you. You and I, as clergy, we're going to be affected by some of the changes that have been made, and that's what I want us to focus on today. Before I go into the pensions, I want to take just a moment to remind you a little bit about the health care benefits. You remember that starting in January, we are going from an apportionment system to pay for the health benefits to direct bill to the churches. That's a very simple understanding of the change that's going to happen. Our apportionment for health care benefits has been split into two: an apportionment for retiree health benefits and active clergy health benefits. That portion, the active health care benefits for clergy, is going to get reduced 25% this year, and then 25% the next year, and 25% the next year, till after 4 years there is a zero apportionment for active clergy health benefits. That means this year there will be a direct bill to the local church for health care benefits, taking care of that 25%. Next year it'll go up, and the next year go up, and the next year go up, until finally the church is taking care of the health care benefits. That's really very simple to understand, but that's what's going to be happening, and it gives everybody a chance to budget accordingly. The truth of the matter is, if you are not participating in the health care program and you're a clergy serving a church, your church is going to get a real boost right off the bat. Most churches will save some money. So that's going to be taking place. On top of all that, I want to remind you of your wellness program. A wonderful thing was implemented this year where we're giving you the opportunity to save $60 a month, up to $720 a year, by meeting 6 different markers. You know what those were. We've talked about them. They all start by taking your blood work test, the things that we offered at annual conference. If you did not take your blood work test at annual conference, you can still do so. You need to go online or call the conference office, get the forms. You then can take them to your doctor. They will then send them in to Bravo Wellness. This does not come back to the annual conference. The annual conference does not want to know your weight and blood pressure or medications. We don't care about that. What we care about is every clergy is working hard to basically look under the bed, face our own reality. What about our health? What are we doing to be healthy? And every time we reach a marker in terms of our BMI or our blood pressure or cholesterol, we save $10 a month. You have the opportunity to save $720 a year by participating in this program. I hope you'll do it. It's not too late. If you didn't do it at annual conference, you can still do it, and we encourage you to do that very soon. That's basically the healthcare things that are going to be going on. We're all aware. Now I want us to look at pensions. The pension program for the United Methodist Church, for you and for me. You know, it's interesting. Our General Board of Pensions is the 87th largest pension program in America. We're the 150th largest program in the world. We usually have somewhere between $18 and $20 billion under management. The good news is we're incredibly healthy. Unlike so many pension programs you're hearing about right now, whether it's someplace like Detroit or whether it's school districts or whether it's businesses, we are very well funded. We are usually right at that 100% funded level. That's just basically unheard of. We're extremely healthy, strong, very large. Your pension program with the United Methodist Church is secure. At the 2012 General Conference, we made a change. And I think it's important to understand that the change was made not because we felt that the old program was too rich or because we thought that it wasn't a good program. No, it was basically made because the Methodist Church is in decline. We all know that since the merger back in 1968, the Methodist Church has been declining. The General Board of Pensions, when we're making decisions about how to invest money in our returns, we're always thinking about a 40-year return. What's the program over the next 40 years? Because we have to look long-term for pension programs, we're also trying to look at demographics and trends and where do we think the church is going. And I can tell you, we better be serious about making disciples for Jesus Christ. The Methodist Church has been in a very serious decline, and if there isn't anything that we change, if we don't do things different, 40 years from now, you will not recognize the United Methodist Church. And those of you who are in your 20s and your 30s, the United Methodist Church is going to look very different when you retire than it looks today. We truly are at a crossroads. Things better happen. It is easy to look at where we are going in the United Methodist Church. So it's because we are in decline that's happening is you have annual conferences that are finding it difficult to make their pension payments to the General Board. One of the factors that so many people don't understand is all conferences are responsible for each other. So if you have conferences like Cal Nevada out in the west or conferences up in the northeast who cannot make their pension payments to the General Board for the program we've all agreed on, and the program is in trouble, then all the other conferences step in to make up the difference. That means you and I could be helping to pay for the pensions of someone out on the west coast or in the northeast coast, and it's because we don't want that to happen that we had to create a pension program that basically all conferences could hold. We found that there was 6, 8, 10 different conferences that really were struggling to make their pension payments, and so we had to design a program that we felt all conferences could be able to sustain. Now the frustrating part of that is there are many annual conferences that didn't need to cut the pension program. There are many churches that would not have cut their pension program. But because we had to design, in a sense, for the lowest common denominator, so that other people weren't paying other people's pension, the program got cut. That's just the reality of it. And so that's what we had to do. It's why we had to do it, because of that responsibility for one another. As we start to talk about the pension program, let's just go back and get clear in our mind a few of those basic definitions so that it helps us all to be on the same page. We all know that part of our pension program is a defined benefit. We call it DB. The defined benefit basically is an amount of money that is agreed to be paid to you because of the service you rendered. The amount of money you receive is based on a formula. So it's a defined benefit, it's a specific benefit promised to you because of the service you rendered. A defined contribution, something different. We call that DC. Defined contribution is money that is put into an account under your name, and it is your money. That money is invested in the market. It goes up, the balance goes down based on how the market's doing. Last couple of years, the market's gone through the roof. All of us who have money in our UMPIP or in our MPP, our DC for CRISP, wherever we had, boy, it's been making the money. If you remember 2008, 2009, when the market crashed, the value of what we have under our own name dramatically went down. All that time, the defined benefit never changed. Whatever had been promised to pay to you, that was what was going to be paid to you. The defined contribution amount, it was going up and down. So these are two different things, two different vehicles that are used to help us to figure our pension program. You can see that one of the differences with the defined benefit is that it winds up ending when you die. You can have some of it go to your spouse. Most people choose 70% in a spouse. So you get your benefit. If you die, 70% goes to your spouse. When they die, then there is no more. With that defined contribution amount, it's an account of money that when you die, it gets passed on to your spouse or your heirs. That doesn't quit until the money runs out. So defined benefit, defined contribution, two different things. We certainly all understand too, DAC, denominational average compensation. That's taking all the Methodist churches around the nation, putting them all together and saying our salary plus housing allowance or parsonage benefit equals a certain amount. The DAC for this next year, 2014, is $65,186. $65,000 a year will be the DAC in 2014. All of these things are going to affect how we understand our pensions. All right, if you are 55 years old or older, chances are you're going to receive your pension out of 4 different buckets, 4 different pots of money. We had the pre-82 retirement program. If you were serving in the churches, in clergy, ministry before 1982, you have some pre-82 pension income. It was a defined benefit, DB. That simply means we'll look and see how many years you served, what is the past service rate. Our annual conference, your Conference Board of Pensions, decides each year what is the past service rate. For 2014, that past service rate will be $630 for every year you served. If you served from 1972 up to 82, you have 10 years of service, and you retire next year, that's $630 a year, so $6,300 for the entire year you would receive, or $525 a month. It's that simple. PSR times the years you served, divide by 12, tells you how much you get a month to live on out of that bucket of money. That's a defined benefit. Now, if you did not start into the ministry until 1982 or later, then you now were under MPP, the Ministerial Protection Plan. MPP went on all the way to 2007, so there's quite a few years. Most of us will have some coverage under the old MPP program. That program really was a combination of defined benefit and defined contribution. What happened was money was being put into an account under your name. That's defined contribution. That money's put in that account. You help to choose how some of it would be managed. And in the end, it just went up and went up and went up. And if the market went down, it went down, but the markets were really going up in the 1980s and the 1990s. If you were an MPP then, chances are you have a nice nest egg that has grown through the years. So that money grows and grows. It stopped in 2007. But whatever was under your account and your name, that's still your money, and it's sitting there, and it's still either going up or going down based on what the market does. When you retire, then what's going to happen is a change that took place at General Conference. And the change is when you retire, you'll look at that balance in your MPP bucket, that account of money, and you now have to annuitize 65% of that. What that means is 65% of it you set aside. It's like giving it to an insurance company, only here it's the general board. You give it to them, and then they promise through a formula to say, here's how much we'll pay you per month until the day you die, or the day that your spouse dies, if you're married. So now it's much more like a defined benefit. That's 65% of your MPP has to be annuitized. 35% of the money that you have in your MPP, you now have to take in cash. Okay? That's a change. In the old days, up until General Conference, you could have taken that 35% and annuitized it with the other 65% for 100% to be annuitized. Can't do that now. You can annuitize 65%, 35% you're now responsible for. The good news is you don't have to take it out of the general board. They have all kinds of programs where you can leave it there. They'll help you to manage it and help you to figure out how do you generate lifetime income off that 35%. The good news is that 35% is your cash. If you decided you wanted to take all 35% to be building a house or whatever, you could do that. Don't recommend that at that moment. Lots of tax reasons why, but you could do that. It's your money. And if you die, it gets passed on to your spouse, or your spouse dies, it gets passed on to your kids. That's a bucket of money that is your money. So, pretty simple. You can leave it with the general board. They can help you figure out what to do with that 35% and make a great return. But you need to understand, there is a change. 65% has to be annuitized, 35% cannot be, and you'll be responsible for managing that money when you retire out of your MPP program. That was a change at General Conference. Now, the good news is, even though changes were implemented at the 2012 General Conference, all the benefits you have earned under Pre-82, MPP, and CRISP since 2007 through 2013, none of those benefits change. Everything as the plan was designed, you will receive exactly as the plan was designed. That's all the same. Only the changes that get implemented in 2014 are going to be different. So please don't get anxious or nervous that what was done then will go back and change what was already there. All that's in place. That is secure. I've already told you the board is very sound in its money. You're safe there. But let's look at what happened from 2007 CRISP to 2014 CRISP. In 2004, the General Conference passed the new Clergy Retirement Security Program, CRISP. And what that was for the next, until 2014, January 2014, it said that you were going to earn 1.25% times the DAC, the denominational average compensation, times the years you served. And then you divide that by 12 and you figure out how much you're making per month. That is a defined benefit. On top of that, you also earned 3% of your total compensation, your salary plus housing benefits. 3% of that was then put into an account under your name. That's a defined contribution. So with CRISP, we had both pieces of this program, defined contribution, defined benefits. Okay? So 1.25% times the DAC times the years you served. That's what the defined benefit was going to be. That has now changed in the next, starting in 2014. That was reduced to 1% times the DAC times the years you served. You can understand right up front, that's a 20% cut to your benefits. If you're in your late 50s, mid 50s, late 50s, 60s, that's not going to be a real significant change to you in how you're able to retire. If you're in your 20s, your 30s, even your 40s, this is significant. You need to pay attention to this. That was a 20% reduction in your retirement benefits. I think that's a very straightforward change. You can look at some of the examples on the slides up on the screen. It's going to be a reduction in what you receive. That's just pure and simple. The DAC right now is about $65,000. We don't know what it will be when you retire. That's why no one can tell you what your benefit will be. It depends on what's the DAC when you retire, how many years you served, and that will affect what your pension payment will be. That's a defined benefit. Pretty simple. Two other significant changes also took place. First of all, there's something kind of known as the marriage clause, very common out in business. We did not have it in the old CRISP program. And I'm going to have to just ask you to kind of go with me on a few things here so I don't get into lots of actuarial issues. But the issue is, it was always felt that what happens is if you're a married clergy versus a single clergy, the married clergy is getting an extra benefit. You see, when you deem to retire and you then say, I'm going to make $2,000 a month, but I now want to leave 70%. If I die, my wife would get 70, or husband would get 70% of my benefit when I retire. That didn't cost us anything to do that. That was just always assumed. That's the kind of thing that you would do. They would receive the benefit till they died, and then the program was over. If you were single, then actuaries are able to figure out these kinds of things. Actuarials are different. They're amazingly brilliant people who figure out some fascinating things if you ever get to sit in a meeting and talk about this kind of stuff. For an actuarial, they would make this statement if they're looking at the benefits. If you were having a monthly benefit of $100 for the unmarried person, the actuarial benefit at retirement, $13,560. For the married, because they're getting the benefit for their spouse, it would actually probably cost $15,950. They're able to figure these kinds of things out. Under the old CRISP plan, when you retired and you decided if you were married you wanted to take retirement in 70%, that did not affect your payment. You were still making 1.25% times the DAC times the years served, and we all got the same. That's not how business typically does it. In business, if you take the married deduction to pass on 70% to your spouse, if you die first, then they reduce your benefits because now there's a greater chance of carrying on the payment because of 2 lives instead of 1. So they reduce your benefit. You can see that what's going to happen is now, starting in 2014, you don't have to elect to cover your spouse with your pension program. If your spouse dies first, no harm, no foul. You just make it. If you die first and you didn't choose to cover them, their pension stops. They have no more income. But if you choose to cover them, the amount you receive is going to go down. It'll go down about 15%. And of course, if you look at that example at $100, now you'd be receiving $85, and then if you die, your spouse receives 70% of the $85, rather than receiving 70% of the $100, because your amount has already been reduced. That's what it costs to be able to have a married option on how your pension goes. Because you're not just covering one life, you're covering 2 lifetimes. But that's the fascinating thing. Who knows who's going to die first? It's just one of those issues. They figure in a huge pool of numbers of people to say, here's what it works out to be, here's the averages, here's what the deduction needs to be. Let me tell you, that's a huge change for you. That'll have a significant impact on the amount of money you're going to be receiving in your retirement. You need to be aware of that one. Third big thing that was changed that affects you financially. Under the old CRISP program, the church put in 3% of your compensation into your defined contribution account, that bucket of money. Whatever you were making, plus housing or parsonage allowance, that total amount, 3%, the church put in under your account. Under the new program, the church is required to put in 2%. That's another 1% reduction where some of your benefits would be. However, the whole concept that happened here was to say, clergy, we aren't saving enough. We're not taking seriously enough our retirement. And so it was established that it's going to say, if clergy, if you will now save 1% out of your salary, whatever that salary is, you save 1% of that, then the church will match that 1% with 1%. So that what would basically happen there is you would still get the 3% for your defined contribution, but you would also have in that bucket of money the 1% you put in. So now 4% would be there. Still only 3% given by the church and 1% given by you. That'd get it up to 4%. If you do not give the 1%, if you choose not to say that, say, I cannot do that, then you will get 2% out of your salary put into your defined contribution. That'll be another 1% cut from your benefits of that part of the benefit. That is significant. Anytime you can give $1 and somebody matches it with $1, that's a 100% return on your money right off the bat. You don't get any better than that. It's to encourage us to say, we better start putting more money aside because our benefits just got cut. Because everybody's situation is different. Are you married? Are you single? You know, how long what you gonna give in terms of benefits for the person who's left behind, your spouse, 70% or what? You're retiring early. There's so many factors, you can't tell a group of people all the exacts. But you can understand that your pension, based on your life circumstances, just got cut probably anywhere from 20 at a minimum to 35%. That is significant. So save that extra 1%. If you give the 1%, the church has to match that to 3%. That's big for you. Let me carry it on from there, though. We need to be saving far more than that if we're going to retire well. We had that special savings through our health care program. If you took the test and you failed every other marker, if you had every other marker you failed, if your blood pressure is at 150 and you weigh 400 pounds and your cholesterol is 320 and you smoke tobacco and you fail every other marker, you still get $10 a month off of your required health care cost. That's a minimum of $120 everybody can get. If you're young and you're healthy, you can get $720. Anybody can get $720, no matter what age. But so many of our younger people who are desperately going to need to be saving, you probably have the greater chance of your cholesterol being right on the mark and having your blood pressure down. I mean, that's just typically the way it is. Our 25s, 30, 35, you probably have a greater shot at that than all of us. Though everyone can do it, you should really be able to do it. If you took your $720 a year that you're going to save and you just simply didn't decide to declare a raise, but you put that into your pension program, the impact would be enormous. Chances are it would mean the difference in several $100,000 in your pension when you retire. And it would be your money. So you can see some of the major changes we're about to be going through. You're going to lose 20% over in the defined benefit from 1.25 to 1% times the DAC times the year you serve. You're then going to lose, if you're married, you will also have a further reduction. If you're single, no other effects. If you're married, you lose a pretty significant amount again. And then if you don't give the 1% at a minimum, then you're going to lose another 1% in the defined contribution. So we all need to start giving at least 1% to get that matching grant from the church that goes into our account. 3 very big things. But let me tell you, there's another thing that you can also be looking at doing. And most people don't talk about this or know about it, but there's no reason not to. The General Board for years has had a program by where a local church can say, I would like to do more for my pastor's pension program, and you can design a specific program that's right for your church and the pastor and submit that to the general board for approval and have a very legal relationship to increase the pension program with the general board. Now that's not something we've been talking a lot about, but that's been available for years. But there's a lot more talk about it now. Because as I said early on at the beginning of this, the pension program got cut not because it was bad or too rich, but because there was a number of annual conferences that were declining so fast they couldn't make their pension payments. We can't do it as an annual conference, we can do it individually. If your church is doing well, and if your church would like to say, we don't think that our pastors should have their pension program cut because the church is declining in other parts of the country or here in Oklahoma, but we think we want to keep that pension program higher, you can do that. You are able to sit down, you may call the general board, they will send you all kinds of forms or ideas. You may talk with our annual conference, call the treasurer's office. They can tell you all about how the program works. If you would like, you can call me here at St. Luke's. I can tell you that's something we did here at St. Luke's this year for the first time. Knowing this new program is going into effect, I sat down with the Staff Parish Relations Committee and said, we're not declining. We're in a very good place. We're strong. We're growing. There's no reason in the world to start cutting the pension program of all these pastors we have on staff. I have a number of pastors back in their 20s and 30s and 40s. I want to do something about that. And so we created a pension program specific here at St. Luke's to be a supplement to the ongoing program. And that's what this would always be. It's a supplement to this program. You can't opt out of this program with the general board, but you can have a supplement if that's something your church decides to do. So if you're interested in that, you can call the general board, call the conference office, or I'd be happy to talk with you about it and kind of tell you some different ideas that you can do. It's something you and your church must decide is specific at your site that you feel is the right thing to do. It's something that's only binding 1 year at a time. So if changes need to be made or a pastor leaves and they want to do something different, the church is not bound to carry on. 1 year at a time is the agreement, and it can be a very helpful thing for your pension program. What I'm trying to say to you today is we all have got to plan ahead. We really need to plan ahead. You need to be thinking about your retirement now. This isn't just something you do once you get into your 60s. The most critical time to actually do it is when you're in your 20s. Have some fun thinking about your pension. You know, Albert Einstein was asked, what's your greatest discovery? And Albert Einstein said, the miracle of compound interest. That's what he said. It is amazing what happens with compound interest. Go home this afternoon and have some fun with the rule of 72. The rule of 72 is simply, you can take the amount of interest that you think your money will make, divide it into 72, and it tells you how many years it'll take for your money to double. If you think your money is going to make 7%, you divide that into 72, it takes 10.2 years. If you make 10% interest, your money will double every 7 years. If you make 12%, your money will double every 6 years. During the 1980s and 90s, we made consistently over 12%. Many periods through history it's making 12%. The last 10 years, with all the bad economic time it's been, actually our special called our MAF fund, which is where most of our money is, returned 8.5%. But most actuaries will say figure 7 to be conservative. But let's just say you looked at that. If you're making 10% on your money, that means it doubles every 7 years. If you had $100,000 at the age of 44, that means in 7 years it's $200,000. In 7 years it's $400,000. In 7 years it's $800,000. That means in the 21 years from the time you're 44 to 65, you would go from $100,000 to $800,000 in your pension program, your sole account. And if you decided to work till 72 when we make you retire, well, that'd actually be $1.6 million. It's the miracle of compound interest. At the end, the numbers get fun. The beginning, though, is how you get them to the point they're able to make a difference. The most important time for you to save is probably when you make the least. There in your 20s, for sure in your 30s, it is critical to be saving in those years, because that's how you finally get to the number that really starts making a difference. I can't encourage you to save enough. Use the money that you're going to get from your wellness savings, out of your salary. Talk to your church. Those are all important areas. You can go online, look at that. All kinds of wonderful helps there at the General Board. You can call the conference office. They can help you think about things. Ernst & Young is a financial planning company that we have with the General Board that you may call them and talk to them about your issues one-on-one with a person for free. Now, I don't know how you get any better than that. We're giving you free advice from certified financial planners who understand our program, who could help you to think some things out. One last thing. Some of you have spoken to me about this, and so I wanted to bring it up. There's a thing called the annuity rate you'll look at on the website. It tells you how your money is going to be put into an annuity. That's 65% under MPP, the money that you're going to have in an annuity in the future. Many people say it's about 3.5% right now. The annuity rate is based on what the interest rates are running out here in the real world. As interest rates go up, your annuity rate is going to go up. But there is a difference between the annuity rate and the payout rate. The annuity rate figures into the formula for how it's going to be calculated. Just take this for what it is. And a rule of thumb at this moment is that the payout rate would be about 6% on the annuity that you create with the board at this point. That's a very rough rule of thumb. You can't hold me to that. It may be a little more, a little less, but that's probably helpful if you were sitting there trying to calculate. How much do I have in my MPP account? 65% has to be annuitized. I'd probably be making about 6% on that money, not the 3.5 annuity rate. Just for your own planning. What I'm trying to say is you've got to plan. You've got to spend some time looking ahead, paying attention to this, and working on it. There's going to be a clergy benefits seminar, September 26th and 7th, October 3rd and 4th. First at Canyon Camp, then at Camp Egan. The 26th and 27th September, October 3rd and 4th. This is not for people who are getting ready to retire. Yes, you're welcome to go. Yes, it would be helpful for you to go. The people who most need it, are any of you out there who are in your 20s and 30s? Get there. If you're in your 40s and 50s, get there before it's too late. Do it now. Not to take advantage of all the information that's being shared is just foolish. Let me recap what the changes are going to be to our pension program starting in the future. First of all, remember, all the benefits of the past, they don't change. Whatever you've earned up to January 1, 2014 stays just the same. Your Board of Pensions is strong. One of the strongest and healthiest pension programs literally in the world. 100% funding, the size we are, you're well secured with your pension program. But it's about to be reduced, your benefits, starting in 14. You're going to get a cut in 1.25% to 1%. That's 20% cut. There's going to be the issue of the marriage exclusion. Are you married? Are you going to take on for the spouse? That's going to be another reduction. You have to give the 1%. If you don't, you're going to lose from 3% to 2% a year that'll be put into your DC. Those are all very real issues. You can take the money you save on your wellness, put it into your pension program. If you and I are willing to put out a little effort, we are not dumb people when it comes to finances. A lot of times we're lazy. A lot of times we like to say, I don't understand. If you put out a little effort, you will understand. The majority of Americans don't ever put out effort to understand. Studies have shown that Americans will spend more time planning a vacation than they will their retirement. If you would put out some effort planning your retirement, you'll understand it, and you can retire well. If we can be of any kind of help, please don't hesitate to call the General Board, conference office. I'll be happy to help any way I can. Good luck.